Hi everyone, this is Zev Fisher at Fresh Portugal, and this is another video on the Fresh Portugal YouTube series. I'm an international tax lawyer. With me, Pedro and Brian. Pedro qualified as a lawyer in Portugal, Brian in the US, and we work here in Lisbon together from our office, helping expats with their tax matters in Portugal. And today is a tough one. We're going to be covering US pensions, perhaps one of the most complicated taxation subjects in Portugal. US pensions under the NHR primarily. So super complicated subject, very unsettled. So don't expect clear and crystal clear answers because there aren't any. But we'll try and at least give you the way we see it and the main guidelines of how pensions work. So yeah, who wants to get started? So yeah, just to try and set up the general outline, perhaps the biggest problem is that Portugal has insurance complementary schemes, and the US has lots of different types of pension schemes, and they don't match. Yeah, perhaps we start with the US side. Yeah, Brian, maybe kind of a quick rundown of what have we got coming from Americans.
Sure, and there's two ways to break it down, and one is to list every possible type of private and public pension that we have, and that would need its own video and be much longer than any of you would tune in for. But mostly they break into a couple of types, and you're all probably familiar with at least one of these types. There are types that you contribute your own funds to before paying tax on them. For most of you, this is a traditional IRA. It's what you're probably thinking of. And then that amount grows. And then one day when you pull it out, everything that you put in and everything that grew in there is taxed when you take it after you turn 59 and a half. There's also a version where your employer can contribute to it. The 401k is the version that most of you are familiar with. Similar treatment, usually. You put in money before you pay tax on it. Your employer puts in some money, and one day all of that comes out, and then you'll pay tax on all of that. And then the last basic type that most of you are probably thinking of is going to be the Roth IRA, where you pay tax on your money and you put it in there, and then it continues to grow and grow and grow. But when you pull it out one day, you're not paying tax on any of it. And isn't that lovely? And then there are combinations of all of these types that exist, different types based on who your employer is, but all of it basically breaks down into those buckets. Money you put in yourself before tax, money you put in yourself after tax, money your employer puts in.
And maybe kind of jumping from that, Pedro can explain the general way that pensions are treated in Portugal, ignoring the US situation, and then we're trying to start building into how these things meet each other.
Sure. Normally, pensions in Portugal are correlated to the Social Security or to complementary or supplementary, depending on the translation of the Social Security system. And, well, both of them are normally taxed on progressive rates in Portugal, and you receive them in the totality of the value, without the separation of the contributions that are so common in the US, especially with the IRA or the kinds. And, well, the treatment will never be the same as you have said in the beginning of this conversation. They don't match. So even if we have these rules from the Portuguese side, deciding that they are taxed at the progressive rate, and eventually under the NHR, if it is a foreign use source pension, they will be under a 10% flat rate. We need to analyze carefully and make try to do as perfect as a match can be, considering all of the circumstances of the difference between the American and the Portuguese pension system.
So let me reword the dilemma, because that's where we're going to start analyzing now. So we know that the NHR rate for pensions is 10%, or, now we know the NHR rate for pensions is 10%. So you're supposed to only pay 10% of your pension saving. But the problem is that out of this bucket of money that you've saved for retirement, some of that is pension and some of that is not, right? And so what is it? So how do we know which part of the money that you've saved for your retirement is pension and which part isn't? And who wants to take that?
Yeah, I will start because this is basically Portuguese law inquiries, but I can just catch from what Brian said regarding the way that this IRAs are contributed, and then sometimes there is a part of it that is a contribution from the employee himself. It can be pre-taxer or not, but in Portugal, these contributions that you do, most of the time they will just grant you a benefit for a deduction, but they are not tax-free, so they're already taxed. And in the moment that you retire, of course, there are contributions from the employee, and sometimes there are contributions from the employer, or there are contributions from the employee and a growth due to an investment that has been done. But in the end of the day, you have to analyze what it is a contribution from the person, the final beneficiary, and what it is not. And if there is a contribution from the employees, there is a contribution from the beneficiary, what it is solely the contribution and what it is the growth of it, which means that the Portuguese legislation allows you to separate, actually deduct from the taxable income that you have, the values that you are being paid back as a pension, the values that refers to the reimbursement of capital, which means the capital that you have invested, the money that you've put it in, and you need only to separate that. There is a specific rule that if you can't separate it, even with, accountability and everything being applied, if you can't separate it, then there is an assumption that 85% of it is a return, a reimbursement of the capital, and 15% refers basically to what would be the growth. So basically, you need to take out everything that it is a contribution and just leave as taxable the 15% that refers to the growth.
Fantastic. So what we do, I suppose let's start perhaps with the easier ones. So growth is pension, right? So any of these plans, growth is pension.
Exactly.
Yeah. And then something that always comes up, a Roth IRA, people are quite disappointed to find out that the growth is pension because they're used to not paying tax on it at all. But at least because some of the money has suffered tax already, it's clear that it's return of capital, or isn't it?
And that, and I'll defer to my Portuguese colleague officially on the Portuguese taxation of that. But, no doubt looking at the American side, we can decide which portion of that is capital you contributed. Assuming you've kept records, it's quite clear what is your contribution and what is growth. And then, while some countries have gone and made rules that correspond to the American tax treatment of these, if a country, Portugal, for example, doesn't have specific rules about how to address these American tax advantage retirement accounts, well, then you sort of look at it as what it is, ignoring the American tax treatment of it. You put money into a fund that you were allowed to access when you turned 59 and a half, and then you started accessing that money. So what is it? Your contribution of capital and the growth. And so we tax that exactly here as those characters exist for those two items. Right, Ledro?
Yeah, seems a very interesting perspective, just with the disclaimer that, of course, if we have further guidance from the tax authorities themselves regarding this specific pensions from the US, as we have with other foreign matters, even foreign pensions, but they are not structured exactly like the ones from the US. If we have a further guidance from the tax authorities or even a modification on legislation, of course, all this treatment will be enforced in the way that the tax authorities guide us or the law.
So, but based on our analysis, growth in all pension vehicles is pension, and then in a Roth where tax was already paid, it's return of capital, which is not part of the taxable amount. Now we have everything in between. So people who made contributions and these contributions have not been taxed yet, something that doesn't exist in Portugal. Really a gray area, right? I mean, we don't know for sure what it is.
Well, we don't know for sure, precisely because we don't have a guidance. So it's really difficult to make assumptions here. But at least if we could create, let's say, paths, ways of creating solutions for that, we could say that there is a specific income being generated there that refers either to pension or as an employment income that it refers to the past, right? It is not current employment income, but it should be one of those. But it's unclear how the tax authorities treat this kind of income. It's unclear how Portuguese legislation treats it specifically, especially coming from a foreign pension scheme. But, well, it's much more of a matter of waiting for it or creating your own logic, of course, with any kind of possibilities that are allowed by the law and allowed by a certain jurisdiction.
So it's interesting because we see that in various things throughout the Portuguese NHR system, but we see that very strongly in pensions that we just people coming from a very well established system like the US system, and perhaps even Portuguese people paying standard Portuguese taxes, they expect or want to know, to have full certainty as to how their income is going to be treated. And it's just the fact is that the influx of Americans in Portugal is a new phenomenon, and the complexity of the pension schemes goes well beyond perhaps any other country. And then we end up in a situation where, okay, we just don't know for sure. So we have to take a reasonable route and defend it if possible, or if needed at some point in the future. And in the meantime, we take a reasonable route, and this is what we do for our clients. So yeah, creative work for us, and just people coming to Portugal have to accept some level of uncertainty. But the bottom line is, it's not that bad. And the worst case scenario is that everything is treated as pension, probably, and is taxed at 10%. But actually, in real life, parts of these pools of money are not pension, which means that they're not taxed at all. Perhaps on some extreme scenario, some of it is employment income, and it's worse than pension, but quite unlikely, right?
Yeah, in my opinion, extremely unlikely.
Because if it's employment income, it refers to the past. Yeah. Exactly. Okay, well, that's pension then. I mean, I probably more questions than answers, but this is just the way that the nature of this income. So thank you for joining us for pensions, and we'll see you on the next video.